Okay, now we're going to talk about how to account for merchandise sales. So you've purchased the merchandise, you have recorded the purchases, any transportation costs you're responsible for, you've recorded any returns and allowances, but now you're selling the merchandise. How do we handle that from an accounting standpoint? Well, first of all, let's go back and look at how we compute gross profit. You have your total sales, but then you may have some sales discounts and some sales returns and allowances. So these would be discounts you offer to people who are buying from you, and then returns and allowances that you have to give because of damaged product or because of just things that they've returned. So that gives you net sales. When you subtract from that your cost of goods sold, you get your gross profit on that merchandise. So let's look at how we record each of these things. Pretty basic here. In order to account for a sales transaction that is on credit, meaning that they don't pay you cash up front, but you're going to allow them to pay it over some period of time, your debit would be to accounts receivable, because you're increasing accounts receivable, and accounts receivable is an asset, and we increase it by a debit. And then your credit would go to sales, because you're increasing your revenue, and we increase revenue, which is the normal balance for a revenue account is a credit. So we credit sales and we debit accounts receivable. Now, once you do that, that's kind of the easy part. But we then have to also reduce the amount of inventory that we have on hand because we've just sold it up here. And what we paid for the inventory is not going to be the same that we're selling it for. So these numbers are not going to match. We have to figure out how much did that inventory that we sold up here cost us. So the cost part of each sales transaction ensures that the merchandise inventory account under a perpetual inventory system reflects the updated cost of the merchandise available for sale. So, for example, the cost of the merchandise that they sold here was only $1,600. So they sold it for $2,400, but it only had cost them $1,600. So we credit merchandise inventory because we're removing it from inventory, and we debit cost of goods sold for that particular amount. Now, we're going to talk about how you determine this amount a little bit later, but just keep in mind it's not going to be the same because this is your sales price. This is what you paid for it. Obviously, you don't want it to be the same because hopefully you're making a profit on all of these things. Okay, let's talk about how to handle a sales discount. It's very similar to the purchase discount. Let's say in this case they sell $1,000 worth of product on credit, and the terms are $210 net $60. So they're giving them 60 days to pay the whole thing, but if they pay it within 10 days, they get a 2% discount. So when you sell the merchandise, you do $1,000 to accounts receivable, $1,000 credit to sales. Now, if somebody just pays you the full amount and doesn't take advantage of the discount, you debit cash because money is coming in, and you credit accounts receivable for $1,000. That's the simple way to do it because there's no discount involved. But if the customer does take advantage of the discount, the 2% discount would be $20 on a $1,000 purchase. So when they pay you, your cash would be debited for $980, but you also debit sales discount for $20, and then accounts receivable would be credited for $1,000. So that gets rid of the total debt, but you charge $20 to sales discount. What this ends up doing is reducing your sales from $1,000 minus 20 down to $980, because you didn't actually get $1,000, you only are going to get the $980. So your sale is really only for $980. Sales discount is a contra revenue account, just like we talked about depreciation being a contra asset account because it reduces the amount of your asset called equipment. In this case, sales discount or sales returns and allowances are a contra revenue account because it reduces the amount of your actual revenue. Same thing is going to be true if you're dealing with a return or an allowance. Sale here for $2,400. It originally cost them $1,600. Now, they return merchandise that you originally sold for $800. So your return is going to be to sales returns and allowances, a debit for $800, and then you're going to reduce the accounts receivable by crediting it for $800. So this is how you handle it on the sales side, but that merchandise did not actually cost you $800. So when you adjust that on the inventory side, you have to adjust it based on what you actually had paid for it. So in this case, the merchandise had only cost you $600. So to handle the kind of flip side of this entry, you debit the inventory account and you credit cost of goods sold for $600. This is the cost amount of what you took back in a return. This is the sales side of it. This is what it cost you. This can be a little confusing, but read this carefully and make sure that you understand what this entry is telling you. Now that's on a return. Here's an allowance. Okay, assume that $800 of the merchandise was defective, but the buyer decides to keep it because Z-Mart offers a $100 price reduction. So they're not returning the merchandise to you, but Z-Mart's going to give them a $100 price reduction because of the defectiveness of it. So the seller would create a credit memorandum to confirm that, and the way that you would handle it is you would debit sales returns and allowances, because again that reduces the amount of revenue that you're going to get, but you would credit accounts receivable because they don't have to pay you now for that $100. So this is how we would handle a sales allowance. Up here with the sales return, they're actually returning the merchandise and you're putting it back into your inventory. So you have to do the entry to place the merchandise back into your inventory. And that's how this would be handled. But here you're not putting anything back into your inventory, so this entry is not needed on a sales allowance, only on a sales return. Okay, that's the basic way that you handle accounting for merchandise sales.